You're watching Stock Watch. I'm Zinati Guma, and join me to unpack your stock-related questions tonight are Pierre Verster from Protea Capital Management and Grant Nader from Benguela Global Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. Grant, I want to start off with you. The record-breaking sessions that the JSE has had while the US markets have been going through it. What's been responsible for this buoyancy on the local bourse?
Isn't it wonderful? It's not very often you see South Africa outperform the US by more than 10% in only a couple of months. It's really remarkable. I think the beauty of our index is we're very much a globally represented index. You've got a big weighting in Chinese tech through Naspers process. You've got a big resources weighting, which is which actually moves in opposite to the dollar a lot of the time. And then you've got the SA Inc. piece, which is the banks and that, which is still a reasonable size, but you've got quite a balanced, almost like a balanced portfolio in our index. And if the rand blows out, that benefits the rand hedges, and they are a big chunk of the index. When the rand is doing well and sentiment is good around SA, you've got a lot of the SA Inc. stocks doing well, the banks and financials. So we have quite a nice index. And actually what's been happening is all sectors have been doing okay. We've had some of the Naspers process has been a big contributor to these strong moves. But the other sectors are holding their own from one day to the next. It's commodities, then it's Naspers process, then it's some of the other sectors. So there's actually a lot of breadth in this all-time high. Yes, it's been carried in some ways by some of the big guys, but under the surface, there's still decent buying interest across a number of sectors. So I'm pretty encouraged by what I've seen. I think there's still more to come.
Well, that's quite encouraging to see that there has been breadth and not really a concentration in terms of the buying activity that we have seen. I want to drill into gold specifically with you, JP, because those gold miners have also been pushing up the bourse. And seeming that there's still a lot more upside, and this is in a time when a lot of people have been trying to see if they can short their gold stocks. Your thoughts there?
Indeed, Zanati. So look, there's a lot of excitement with gold. It's gone through $3,000. If you look at the physical gold, the US is holding on to physical gold. So there's a shortage in London. So the London Metals Exchange, the traders there are struggling to get their hands on physical gold, which is also pushing up the price. We have some people talking about a Mar-a-Lago accord, some type of agreement of the US potentially devaluing the dollar, and that's why they're bringing the gold. So there's all kinds of interesting theories why the gold price is so strong. And obviously, what do mines do? They dig this stuff out of the ground, Zanati. So if the stuff that you dig out of the ground is going up in price, your profits are going to go up and you're going to do well. And that's what we're seeing. So much excitement that some gold miners are trying to buy some of their partners, like Gold Fields, Gold Roads, Gold who knows what. And let's see. Normally, just to be a little bit contrarian, when you get this excitement and the M&A starts flowing and the profits start gushing out from these gold miners, it's a time to be wary. So at the moment, there's still quite a gap between the spot gold price and the valuation of these companies. So you could say if the gold price stays here, the gold miners are too cheap. But that's a big if the gold price stays here. So it's an interesting one over the long term. I'm not a gold bug. I'm not a fan of the miners. I wouldn't mind some physical gold or gold ETF as a small portion of my portfolio for diversification purposes. But yes, they're having their time in the sun, the gold miners currently.
All right. Well, let's go into other miners that don't have gold in their portfolios, starting off with BHP. 5 to 10 year view on BHP, Grant?
I think BHP is one of the better miners out there. They tend to be, they allocate their capital well, they manage their costs well, their operations are strong and solid. They're one of the higher quality miners. The only thing against them at the moment is they don't have I would say, enough copper relative to the other assets. They're dominated by iron ore and the like. And of course, at this point in time, the outlook for copper seems to be a lot brighter than it does for iron ore. But things change, and BHP is making a strong push to increase its copper portfolio as well. It's a good management team. I think you'll be 5-10 year view. You can definitely hold BHP if you want to be in the miners, definitely.
Well, JP, I'm going to give you Thungela. There's a question here. Okay, let me just go to that email. It goes. Yeah, it just says your view on Thungela. I didn't need to go there. But they recently...
It doesn't need to be a complicated question because it's not a complicated company. All I can say is there's one variable, and that's the coal price.
Yes.
So your view for the next 10 years about the coal price will inform your view for the next 10 years about Thungela. If the coal price, I'm going to use the Richards Bay free on board price in dollar terms.
Yeah.
If that stays, well, currently it's below 80, but if it stays below 100, you've got a problem. So at below 80, Thungela is probably burning some cash currently. They're not making profits on a spot basis.
Yeah.
Yes, they do have some contracts, but those will roll off. Below 100, it stays there. Their costs will keep on increasing, so their profitability will see a pinch. So you really need the coal price to move closer to $120 and sustainably higher from there for Thungela to try and make profits again. We were clearly in a coal bubble just after the Russian invasion of Ukraine for about a year. That's why Thungela went through the roof. That's why they paid such juicy dividends. But those days are over. Europe has caught up with their energy requirements. They are importing gas, LNG. They've made alternative arrangements, so they don't need to be paying over the odds for coal anymore. So I'd be very cautious, and it all depends on what the coal price is going to do the next 10 years.
And then using the Newcastle coal price and how they're,
Yes, so Newcastle, that's not the KZN Newcastle, that's the Australian Newcastle, also a big export harbour for coal in Australia. There's normally a difference, but not a huge difference. And yes, they now have got a mine in Australia as well, so they can get some exposure to the Newcastle coal price. But whether it's Richards Bay, Newcastle, coal is coal. You just need a ship to take it from point A to point B. So the dynamics are the same.
All right. Well, let's go into telecoms because they had a very, very big day in the sun today, yesterday. I see that, I think I looked at MTN earlier and it was still in green trading. Grant, was there anything specific yesterday? And actually all of them were up by big margins.
Yeah, so I didn't see a telco specific. I feel like it was a portfolio trade, rotation within sectors and around the SA Inc. basket. But telcos they've been recovering. They've lagged the rest of the market for some time. The last month or two, they really are playing catch up. I must say, MTN is performing better than I'd expected. I have some concerns or reservations about that one, but the share price is doing well. They're starting to maybe turn that Nigerian operation around. We prefer Vodacom. That's also lifted its head a bit. But as for the whole sector, what got it moving? No, I didn't see any news, and maybe I missed something.
Well, I mean, I'm sure it wasn't the announcement from Telkom that was telling us about the disposal of Swiftnet, because we have known about that. There's actually a question on that. Now that Telkom has approval to dispose of the cell towers business, should we see an increase in the share price? I would think that news has been baked in, JP.
I would agree with you, Zanati. So you might see an announcement of a special dividend that might be more or less than people expect. That could drive the share price up or down. And then after that news flow about how Telkom Mobile is doing and the bits of the business that they will keep. So yes, there could be a little bit of movement still just based on the announcement of what is the special dividend going to be once everything is wrapped up for this deal.
All right. Well, let us go into more questions. I'm going to go to Sun International. View on Sun International now that the CEO is leaving. Why is the share price not liking Anthony leaving the company in June? Is Sun International still a good value buy at current price? Let us start off. I actually didn't notice any kind of significant movements yesterday after the announcement that Anthony Leeming is taking early retirement. Of course, he will be that will come into effect on the 1st of July, but he will be staying on until the end of December. It's down just 1% today, and I don't think there was any significant movement yesterday, or was there? Grant?
Zanati didn't look too material, to be honest.
Yeah.
I mean, look, he's done a very good job. He's been at the helm a very long time. They've had plenty of time for succession planning. The concern here is that it's a very short notice period. So obviously, something's come up. This kind of thing would normally have a much better transition and handover period. So if you want to be worried about anything, that would be it. But typically, with so little movement that they've had over a number of years, there should be a very settled and established management team there that could pick up the reins. So I wouldn't be fundamentally concerned. Maybe it's not ideal, but I also think hopefully that there's a reasonable succession plan in place.
Yeah, but the new guy actually has a very, very impressive resume. So just, a lot of experience.
I don't know him. I don't know this guy, so I can't comment.
Yeah. I mean, from what I read, I also don't know him personally, Grant. But
I don't even know of him. Let me rephrase that. Let alone know him. But I'm assuming the management team around him is still very capable. But
I mean,
we will see.
It's interesting because he's got a lot of experience in gaming, and I guess it would fit in with the kind of strategic transformation that Sun International is trying to go for. Just looking at the current fundamentals of Sun International, I guess maybe taking in the new leadership, is it good value, JP, at the current price?
I think Sun International is decent value. I think it's trading around fair value, which is not bad, very cash generative. And if I compare it to Sun Gaming, I think Sun International has been better to adjust, as you say, this transition where most gambling these days are happening online, on your mobile phone. That's why every second sports team in South Africa and every third stadium in South Africa has been sponsored by an online betting group, because that's where all the money is going. And Sun Gaming missed the trick there. They're behind the curve. They're still very much a physical betting business with a lot of physical casinos. Sun International is called it 50-50, with Sunbets doing very well. They might have started it a little bit too late, but thank goodness not as late as Sun. And then you have the online players, which are eating everyone's lunch. So I think Sun International is a decent opportunity at the current price. The new CEO does have a lot of experience when it comes to online betting. So it's going to be very interesting to see in the next few years how this battle between the online players and the traditional bricks and mortar players play out. You probably need to see more of the brick and mortar players use their strong brands and their loyalty programs to get their clients to bet with them on mobile apps. That is the key to be successful, I believe.
All right. Well, I'm just looking forward to see the new guy's paycheck. All right, gents, more questions coming your way. Let's start off with BYD. Investment case for it, their battery tech, and whether they will ultimately be the winner in the EV space. I think, JP, you have favored this one in the past.
Yeah, it was my stock pick about 6 months ago. When I chose Build Your Dreams, BYD. And in this week, it came out they're now the biggest EV, that's electric vehicle manufacturer in the world. They reached $100 billion of revenue, even more than Tesla. A lot of hybrids in there, not just pure battery electric vehicles, but they are the leading EV manufacturer in China. And as you say, the battery technology is very impressive. They announced a new technology which will allow you to recharge your battery in 5 minutes.
Wow.
Which is very impressive and could really change a lot of people's perception about EV vehicles versus internal combustion engine vehicles. And then the technologies regarding your sound system, entertainment system, information system in the car, the Chinese players in general are really doing much better than the traditional German, European, and American car manufacturers in terms of using technology in the whole of the car, not just in the engine. So yes, BYD seems to be a long-term winner. They need to navigate tariffs, and they are doing that. So instead of just exporting cars from China, they're setting up manufacturing plants in other places around the world. They had some issues in Brazil, but they're sorting that out. The shares aren't that cheap anymore. It's done very well. I think it's up like 70% in the last 6 months. But over the long term, it does seem like a winner. So I would watch that share price, and on weakness, it's an opportunity to buy some.
All right. Well, talking about weakness, let's change the Dow from electric vehicles to beauty. Estee Lauder, the viewer's asking, why is Estee Lauder stock price down to levels last seen 10 years ago? And is it worth a look at these prices? From what I remember, that's been under pressure for quite a while, Grant.
Yes, Sonati, it has, and I think we've looked into a little bit into this one and some of the space. It's actually highly competitive, and there are a lot of low cost competitors like Ulta Beauty. I think is taking a lot of share from Estee Lauder, and the ones who are surviving are the ones playing in the premium level like L'Oreal.
Yeah.
They're still doing okay, but and the sort of more broad targeted areas with a narrow portfolio. Like Estee Lauder, the stock's down 50% over the last year. And it hasn't gone anywhere for many years other than the COVID bump. So I think it's a difficult space to play in. There's cost competition coming from everywhere, and the disruption from social media influencers selling personal brands and the like. It's a tough space to play in if you don't have a very strong brand. And so I would stay away from this one because I think it's a value trap.
Okay.
And you're bottom picking here. It's not, I think it's cheap for a reason, or I think it's going down for a reason. So I'd be careful.
All right. Well, let us go into food producing stocks, AVI versus Premier as a long-term investment. JP.
Sure, I like both. Two very good management teams. You probably need to think about what they are exposed to. So between the two portfolios, maybe AVI is more branded.
Okay.
Their margins are much wider. Their margins are some of the best margins in the world when it comes to a food producer. So it's mostly coffee, tea, cookies, chips, snacks, that type of thing. So if you like your rosemary creams, your baker's biscuits, your Willard's chips, those are the type of brands they own. And potentially those are stronger brands than the bread and rice and some of the staple brands that Premier is exposed to. But two excellent businesses, very good management teams, so I wouldn't mind having both in my portfolio.
Okay. Would you have a preference there, Grant?
I would only choose AVI because of the diversified portfolio. So I think Premier is a fantastic business, but you are paying up a lot more than you are for AVI. And they're also, at the moment, predominantly milling and baking. So, I think Tigers is going to try. They're throwing a lot of money at it. So I think that it's a very competitive landscape. I'd prefer the diversification of AVI, but they're both great businesses. Agreed.
Well, a technical question here. Is there a difference in returns between actively managed ETFs and stockbroking accounts, JP?
Well, if you say that the active ETF will theoretically have the same portfolio inside of it than the stockbroking account, the difference probably comes down to taxes. So if you have a stockbroking account and you own those shares directly, every time your portfolio manager sells a share, it would trigger tax for you. While if the investment manager of the active ETF sells the share, the active ETF is normally some type of derivative on a balance sheet of a bank or a CIS, a collective investment scheme, that shields the holder from capital gains until you sell the active ETF. So if you think about it, it's normally better from a financial point of view to defer taxes, pay them as late as possible. And therefore, all other things being equal, if it is the same underlying portfolio, you'd probably prefer to hold an active ETF rather than holding the shares in a stockbroking account.
Your thoughts on that, Grant?
I think it depends on what you're looking for. So if it's an active ETF, you have no say, you don't get involved, you just find out what happened on any given day in the portfolio. In a stockbroking account, it may or may not be discretionary, depending on how you've set it up. But in theory, you could pick up the phone, chat to the stockbroker. You could say, I don't want this in my portfolio, I want that. So outside of the pure returns, you do get a little bit more. You can be closer to the action. You can be involved if you want to be involved, include and exclude things. So it does give you other benefits, I would say, and I'm not selling it in any way. I'm just saying it, to me, an active ETF, you're just an observer. It's like putting your money in a unit trust, but it's listed on the exchange and it gives you more liquidity and things like that. But it does offer something different for the experience that you get as an investor, and I think that's probably the big thing to think about outside of the tax that JP rightfully mentioned.
All right. Well, gents, there's another comparison that's just come through, and I think that is the last question before we get to your stock picks. Which is better, BAT or Richemont? And I get that we're not comparing apples and apples here, but your take, JP?
Yeah, so it's cigarettes against luxury goods, mostly jewelry. Cartier is the big brand within Richemont. And between the two, I think the one's clients are dying and the other one clients are getting older and richer. So I'd probably go for the Cartier client base rather than the Rothmans and all the other brands that British American Tobacco owns. So there is a valuation call between the two. Richemont is more expensive than BAT's currently. But if your time horizon is long-term, I think Richemont is a better business.
An interesting point that you make, that Richemont is more expensive and BAT is not. Grant, how much of a consideration would that be?
There's a reason it's more expensive. I think you're getting better quality, better growth prospects, better outlook. So yeah, for me, I would be happy to pay up for Richemont over buying not everything that's cheap is value. So I would avoid BAT. So I think, as JP said, the prospects are average at best. Until they get the next generation products really growing strongly, which they still got a way to go.
Hey, not everything is that's cheap is better. I was going to ask about Sasol, but I think we are running out of time. So let's get to your stock picks. I'll leave that for Simon for tomorrow. So tomorrow I'm going to give Sasol and Omnia to Simon.
Sure.
JP, your stock pick for today.
So my stock pick is a US listed holding company called Deckers Outdoor. Now, they don't do decking. They don't do anything outdoor. They manufacture, distribute, and sell shoes.
Okay.
And it's mostly two brands, and that's Hoka shoes that are running and active shoes, and UGG boots. Now, a lot of people have their views about UGG boots. They think
like
they're ugly.
Uggs.
Yes, yes, Uggs, or the Australians say Uggs.
Okay.
Because and the British also, because it's like ugly, it's Ugg. So UGG boots, whichever way you pronounce it. Sheepskin boots, very comfortable. Apparently you should not wear it without socks. With socks, because then it doesn't go around your toes and make it very soft, but it can get smelly if you don't wear socks.
Yeah, of course.
So there's two ways to wear your UGG boots. And then Hoka is the shoe with the big sole. So apparently it's very comfortable to walk and run on Hoka shoes. And people are buying their UGG boots, they're buying their Hoka shoes. They want to stand and be comfortable. And that's why the shares have been doing well. But in the last 3 to 4 months, it has come down a lot. Some of the air has come out of the excitement of the potentially bubble-like valuation. So much more reasonably priced, while the outlook is still for strong growth, especially outside of the US. So they've already got significant market share in the US, but the growth opportunities outside of the US. So yes, instead of buying a pair of UGG boots or Hoka shoes, rather go for Deckers Outdoor shares, and you can buy some shoes from the dividends you can get from the shares.
Yeah, and also don't wear them too much, because when they get older, they just go like this. Grant, your stock pick for today.
Okay. So my pick is one of the biggest cybersecurity companies in the world, Palo Alto Networks. And if you think about this data-rich world that we're living in, if you think about the explosion of AI and the tools it's putting into the hands of criminal actors around cybersecurity, I think it's a non-negotiable for pretty much every single business and every individual. These guys they're really at the cutting edge in terms of cloud, in terms of AI security, firewalls, you name it. So for me, I think if you're taking a 3, 5, 7-year view, this is one of those companies, or at least a sector, you definitely want to have in your portfolio.
Yeah.
So it's a great business. It's a little bit pricey, but it's all relative, I think, to the longer term growth potential that it has. So Palo Alto Networks is my pick.
Indeed, very relevant, as we did have yesterday Astral Foods coming out and saying that they fell victim to a cyber attack. So even the chicken business does need those security. Thank you so much for your time and for your analysis today, gents. Much appreciated. That is all for tonight's Stock Watch. Thanks to our guest, Pierre Verster from Protea Capital Management and Grant Nader from Benguela Global Fund Managers. Up next, The Close. Stay watching.